And I am here with not a black screen, but I'm here with Paolo Macro, who, as you know, goes by his handle Cloud Bear, and is anonymous in face, but not in voice. So we're going to continue to respect that. Hey, Paolo, how are you?
Hey Maggie, thanks so much for doing this and having me. It's been so quiet lately. I figured we'd have a leisurely chat, you know.
Yeah, like there's not a lot to talk about. It's going to be a real struggle. But very seriously, I have been saying, and I will continue to say that I really appreciate being able to talk to you and folks who have experience and who understand markets, because I think this is a really kind of fraught time and people really need to hear from folks like you. So appreciate you taking some time out of this crazy busy trading day, because we're in the middle of this thing. And so just sort of top level, give me your thoughts on the action we've seen over the past 2 days, because you almost can't believe your eyes when you look at the screen.
Sure. Yeah, it's every few years we run into unprecedented territory in markets, and certainly this one seems self-inflicted. Without kind of turning any market commentary into political commentary, which is not really what I do. I like to trade and invest in markets as I think they are rather than what I want them to be, or at least that's the objective. These wounds seem self-inflicted, and the word I keep coming back to is confidence, whether it's consumer confidence relating to availability of goods and prices, price stability, whether it's management's trying to plan for the future. How do you build a factory in 4 years? Is it even possible? What is it going to cost? Where's the equipment going to come from to actually do this? And whether all of this will just be upended in 4 years at the next election cycle, or whether it's investor confidence, which clearly took a hit over the last week with these, I don't want to say unprecedented levels of volatility, but certainly pretty extreme levels of volatility, even for people who were trading through COVID 5 years ago. So the word I keep coming back to is confidence. I know we had a huge relief rally yesterday. I know that the night before, I actually recorded a conversation that I do from time to time with my friend LaShrub, who's a fellow writer on Substack, whom I think you know. And
Yeah, love this stuff.
it's funny because literally the next morning before the markets ripped, he called me and he was like, "Man, we were too bearish last night. Like, people are going to think we're such a contra." And I'm like, "I know, but like, you have to own the fact that you can be worried about the longer term sort of outlook for the world and not necessarily get run over when you get a squeeze like what happened yesterday in a relief." It's interesting because I made some decent money yesterday on the pop. I stopped out of a few shorts, obviously, like a lot of people did, but it was a good day for the home team, and yet I felt pretty bad about it. It was a very crazy day in like just emotionally sort of challenging. And then I sit here and I think, we're 12 weeks into this administration and we've got 4 years of this. So just get your helmet on and and strap in.
Yeah,
It's
you bring up a really good point. Is there damage from the level of volatility? I mean, you're talking about confidence in lots of different ways, but I mean, we still have the VIX at 39 as I'm looking at it right now, and everyone's excited it's down from 60. But, at this level, we're talking about percentage moves that we haven't seen in days and days of this.
Yeah. So to give you an idea, I believe it was either Monday or Tuesday. No, on Monday when we were kind of probing the lows, the implied volatility for options expiring at the end of the year, so call it 9 months, as opposed to the VIX, which is kind of 30-day, volatility proxy, was pricing in. I believe the number I heard was something in the 40s, which basically implied a 2.5% daily move in the S&P each day for the next 9 months. So we went from a situation a couple of months ago near the highs when you had even extremely well-respected, and he's one of my heroes, Stanley Druckenmiller, saying this is the most business-friendly administration in history. And Bill Ackman's on CNBC talking up the amazing times ahead. I mean, the bullishness was so palpable that even the guys who've been around for 30 or 40 years were sort of sucked into the moment. And volatility was extremely cheap. And it's amazing how quickly we go from insurance being extremely cheap to being expensive to a point where it will really take a lot of rock and roll for us to realize 2.5% daily moves in either direction for 9 months straight. I mean, that's pretty extreme. It shows you that there is a level or has been a level of fear and just, get me out, or, get me some insurance, whatever the price. But the real question is this over? As we know from having seen a few bear markets over the last 25 years, these things are a process, just like tops are a process that feel like they take forever. Eventually, bear markets, I feel like people's baseline of what constitutes a bear market was sort of skewed or warped by COVID, which was so fast, but so steep. It was kind of like a 1987 catharsis on steroids that was over relatively quickly from the market's perspective. It happened so fast almost that I don't think people even necessarily noticed it on their 401k statements at the end of the quarter. But the real sort of bear market is the one that just beats the enthusiasm and the confidence out of people. And if big operative word here is what we're in for, there is precedent for the moves that we've seen recently on the downside to be sort of the firing or opening salvo, and that these things will take time. One base case, so I wrote a note this morning, just got it out about an hour ago, where the steepness of this decline and the timing reminded me of what we saw sort of in the flash crash in that kind of April-May rollover of 2010 coming out of the GFC. Mm-hmm. We had a bounce in a very powerful one, but we almost immediately, like a week or two later, rolled over and made new lows, not by a lot, 5 to 10% below the crash lows, and then kind of worked that area for a month or two. And as that bearishness built up, then along comes Ben Bernanke, the Fed chair, with his famous Jackson Hole QE2 speech, and the market just turned around and never looked back. Another option, actually, that occurred to me was that this feels a little bit 1997, 98 in some ways, just in terms of analog. And a famous one was the Hang Seng, which had an initial break in 97, if you look at it on the chart, and then came back and chopped around for about a month after recovering sort of half the loss, and then rolled over into what became the real Asia crisis and rolled into a bear market that lasted about a year. So there's precedent for us to kind of inject some relief and enthusiasm back into risk assets in the near term. Obviously, the market is down today, so it looks like this. Actually, another analog that I looked at and I commented yesterday was the biggest update I've ever seen was early in my career in January of 2001. The Fed came out of the holidays, I think it was January 2nd or 3rd, cut rates by 50 or 75 bips unexpectedly, and the NASDAQ exploded up 14% that day. I'll never forget it. I mean, that's a real move. We did 12% on the NASDAQ yesterday, and that was the second largest number after that 2001 example. And yet it was a one-off. And then we immediately started sagging again, and the bear market went on for 18 months. So there is room to accept here that this was a starting shot and that we have a little bit more to get through. And, what I'm trying to solve for is what that path kind of looks like. Is it a 2-year bear? Is it, a retest of the lows in a month or two? Is it the auspice, the initial moves in a larger crash? I have no idea. But for me, I think, staying patient, knowing what you own, keeping a lot of cash. I personally, despite seeing volatility explode in the last week, I still don't really feel like I saw fear. And I know that's crazy to say with a VIX at 60. I don't know people who are really jumping out of windows and jumping out of their skin. Maybe it's just because a lot of people work from home and trading floors are kind of de-staffed. But I don't know. The other thing that really worries me is how the dollar behaves in all of this, which it continues to leak lower. I know there's a lot of bearish sentiment around it now. U.S. exceptionalism is over. We kind of got to that end point of the end of U.S. exceptionalism, became very visible. A lot of people like Julian Brigden, James Aitken, and other well-known, very thoughtful strategists sort of all came out at the same time with this thesis that the height of Mag 7 and U.S. equities and percent ownership by foreigners in U.S. assets is over. And suddenly that was consensus out of nowhere, and we got this kind of mini crash. It takes a bounce and a rinse out of that sort of sentiment for us to start to leg lower again. but I am concerned that the dollar is not really going anywhere and that the bonds are not acting like a flight to safety. I think that's where really the next thing to watch is from here for kind of investors sort of overall framework. Sorry, that was a lot, but that's kind of the whole 360.
The hope with this conversation is that you talk a lot and I talk as little as possible. Hey, everybody. It's nice to have you all join. Hey, Tony. Tony Greer's in the chat, and Tony said
Tony G.
Oh, Tony G. We were on, and he said this is a day-to-day market right now. To your point that even if you want to believe something, it's just so volatile. So let me ask you about the dollar. So what is it? Talk to me a little bit more about what it is that's concerning you. And are there other parts of the market that, what are you thinking about bonds? Because I just talked to Russell Clark and he's really concerned about bonds and the potential for rates to go much higher. So what are you looking at for dollar and bonds?
Yeah, so this is where we've approached the territory where a lot of relationships that we've held sacrosanct among asset classes are showing signs of inverting or flipping. One big one, even looking back over the last couple of years, has been that as our long end sells off and those yields rise, that's sort of a magnet for the dollar to rally because the differential between what you can earn on our long dated debt versus Japan or Europe widens and makes our bonds look relatively more attractive from like a prospective returns standpoint. So rising long yields and widening long yield differentials versus the rest of the world is dollar positive. And that's not happening now over the last month. Then I think back, and this is before my time, so I don't want to date myself too much, but I certainly wasn't old enough to be trading 87. But a well-known analog around all of this, admittedly with much longer lag, is that we had the Plaza Accord in 85 where Reagan basically strong-armed the Japanese into strengthening their currency against the dollar, but also the Germans and the Europeans, but especially the Japanese. And so as the dollar weakened against foreign currencies starting in 85, that sort of strength or weakening of the dollar in 85, 86, 87 was actually what touched off the initial selling in the second half of 87 around foreigners who owned our assets in the mid 80s and started to stop out. And of course, they all, eventually culminated in stopping out on the same day with the famous Black Monday 20% crash. But for me, I draw a straight line just 2 years in the making from the Plaza Accord in 85 to the crash in 87, because when foreigners suddenly panic at the currency their assets are debased in and decide to sell all at the same time, you get Black Monday. That's not so much what's happening here, but there's no lag of 85 to 87 either. If you look at how suddenly everybody is becoming hip to the end of American exceptionalism, the fact that the Europeans have bought 9 trillion of U.S. equities over the last, call it 5 years. And now the euro is starting to rally. So they've got a translation issue on the currency. They clearly recognize that they're in an overvalued asset class in relation to the volatility in the landscape. Many other players here in America and abroad have to degross or take their leverage down as well, because remember, leverage and ownership in anybody's book, but we can talk about multi-strategy pod shops as a starter or a most extreme example of this. Their leverage, their gross, the amount that they can carry versus capital against their positions is a function of volatility. If volatility rises in fixed income and equities together, which is unusual, then they are forced to start shrinking positions across the book. And these things happen kind of on a rolling basis. It takes time for people to make these decisions, for risk managers to process what's happening, for models to touch one after another off. But who can possibly deny that volatility in both equities and fixed income is exploding at the same time that the dollar is sagging? And I imagine putting the skin on of a European family office or a Taiwanese pension, looking at this and watching my currency strengthen against the dollar. I only come out one way, which is I need to cut back as well. Those decisions happen more slowly with real foreign money. My friend Shrub and I like to joke that, European Klaus from CIO of a fancy German insurer will probably only be meeting his committee in May to talk about what's happening. But once these guys meet and they start to move, these trends take forever because the numbers are so enormous. that's what creates the trend and the emerging consensus. So I don't want to sound, panicked about any of this. I just think that we've started new trends with a very loud bang. And to Tony G's point, a day-to-day market, I like to add and say, cash is a position. And I think that's what people are going to continue to grab for as they work out what they really want to own.
Is there, I mean, what you're talking about is a seismic shift in the kind of global portfolio holding, right? Like if you're,
Yes.
so it sounds like this is absolutely terrible for U.S. equities on a really long-term basis. And that has huge consequences in a way maybe it didn't in 87. We've sort of privatized a lot of pensions here in the U.S. So many people have their retirement in 401s. So,
So to be
it's
clear,
more than bearish, Paolo. I mean, how is it possible for this to happen and things not break? I mean, it just seems like.
Yes. And actually that's my base case in all of this, mind you. I don't mean to sound, I'm a cloud bear. I'm forged in the crucible of .com and the bear market thereafter. So I was kind of tainted early to be cynical, and I had to fight that urge every day to look on the bright side. I know like people have been throwing around Black Monday and crash and this. That's not what I'm using these as kind of analogs to explain why a declining dollar sets up a bear market in U.S. assets from the perspective of the very foreigners who have been shoveling money into our financial markets or recycling their trade surplus, our deficit, into our current account and capital account over the last many years as a very long-term trend that I think is finished. That's not to say that the sky is going to just fall and it's lights out forever. It's again that these things are a very long-term, slow-moving process, and it's important to understand kind of in the background where the longer-term trend for this is going. I think that, again, without seeming histrionic, we can all agree that the multiple on Terra Cap, Mega Cap, U.S. equities has been wrong over the last several months and probably last couple of years. The Cape has been up in the 30s, so you're getting an earnings yield of even smoothed out and trying to normalize for elevated profit margins, because our government public sector deficit is the private sector's credit. So we have some of the best looking private sector business profit margins in history because we had some of the biggest deficits in history by governments, and that's not sustainable. Right, the bond market's starting to tell you that that's not sustainable. So profit margins eventually will start to normalize, or at least they should. And with that, you would also expect people to ascribe a lower multiple. The clearest example I can give you, and this is more short-term rather than very long-term, like Cape 10 to 15-year kind of outlook, is that the S&P, if we were to look at even like a mild recession or even just a growth scare, I'm in the mild recession camp and have been for several months before all this liberation confidence gut check happened, is you take S&P earnings down to say 250, and you, instead of running a 22 multiple, you run like a 15 or 16 on it, and suddenly you're down at 4,000 or less on the S&P. And that sounds terrifying, but it's actually kind of middle of the road just on like a look forward 12-month sort of basis. So I say this as an example of like simple numbers that people are running right now, like kind of napkin math, to suggest that the bear case may seem extreme from a degree of move from where we are now, but it's really not on paper when you look at even remote normalization of elevated profit margins and a more normal multiple. I can argue easier for the more normal multiple in the near term because of what's happening with capital flows and the sort of challenge to both management and investor confidence that all of this volatility has precipitated. So again, I'm not calling for a crash here. Like, I'm not saying 97 Hang Seng. It's one analog I look at in terms of like near-term path, but it's not a base case for me. And I certainly won't be out there saying, hey, I called the crash if it happens. That's not what this is. But I struggle to see us making new highs. And I hate saying this out loud because that probably means that the market is going to shake all this off and go right to new highs in a month or two. But I don't get the sense that, and listen, like market action will also dictate if the tape settles down, internals kind of heal themselves. We flush a new low in reverse. There are things that I would look for to, ascribe increasing probabilities to, revisiting the highs. But I that's not kind of what I'm working with, especially with the dollar and the bonds being sort of my top of mind focus.
Yeah. Listen, I think in this environment, if you are not exploring if everyone is not thinking of the bear case scenario and sort of making sure that you're adjusted for that, you're not doing your homework, right? I mean, it doesn't mean you're married to it, but this is the process. So let's flip it in the bull case, because I'm sure you're looking at like what could go right, so that I'm ready for that. And one of the things that we hear is that, or I'm hearing, or I had people tell me, is that, listen, you have Scott Bessent. He's a guy who knows the markets, right? He's a former hedge fund manager. If he's got the president's ear and he's in a position where, he's in the inner circle and they're listening to him, he has described this as a rebalancing. They're worried about the debt. They're worried about trade. They things have to change. And it's going to be pain in the short term, but they know this is the window to do it when they're first in office. And then the good stuff's going to come. If they can get it right, that you'll have lower rates, you'll have, which is a question mark, I know, you'll have deregulation and you'll have animal spirits, all of those things that the market rallied on hard after the election, that will happen. But you've got to get a little bit of pain first, and then you're going to see all of these positives that are going to make people want to invest in the U.S. and that are going to help markets overall.
Yeah.
Does that seem like is there a path that's possible to that? Do you think Bessent can pull that off, or Bessent can pull that off?
It was a very nice narrative. And in truth, I'll admit, I was philosophically sympathetic to that, because the alternative of the 40-year trend in asset inflation driven by the recycling of foreign, our deficit with the rest of the world into our assets. So we buy stuff on credit from everybody else, and they, in exchange, we sell them NVIDIA at, 30 times sales. Unfortunately, the side effect of that is rising inequality of wealth and incomes in America, and the median income in America, the median wage has gone nowhere from the early 80s. And that creates in extremis, and run that experiment long enough, you end up with, enough kindling on the ground and initial conditions where a let them eat cake moment results in guillotines in the streets. And as someone with 4 kids, I don't want to live in a world like that. So I appreciate and sympathize. And again, I don't mean to kind of shake people with like extremist language. It's not, but there's a reason why Trump is in power. It's not because people, a lot of people who voted for him like him. He won the popular vote because, despite the fact that the economy wasn't in recession, because there's a populist backlash to a lot of structural trends where people have felt disenfranchised and left behind, and just would rather see the world burn for a little bit if that means that we can get to a place where things make more sense for the average sort of worker and employee. But that said, as Scott Bessent mentioned, there's going to be a detox period. It's been a week, and we've had one hell of a detox already. I question, just based on some of the chats that I've seen from people who voted for Trump and conversations with wealthier supporters who have seen their faith a little shaken, not because they didn't want to underwrite the original sort of message and philosophy of shifting this, Titanic in a different direction and trying to do it relatively quickly, because there is a timestamp on this. If if the detox period goes on for too long, you get a backlash to the backlash, right? I've always said that I don't necessarily worry about Trump. I worry about what comes after Trump. And then when Biden was elected, and I say, I don't worry about Biden so much as I worry what comes after Biden. And here we are with Trump, and I'm telling people, like, I don't worry about Trump. I really worry about 4 years from now and what comes after. The metronome just keeps swinging kind of wider and wider with each tick. And so coming back to your question, there is a window of opportunity in all of this, but it was contingent upon near flawless execution The best analogy I could give you is Argentina under Milei. Nobody gave him shrift when he was elected because all they saw was the wild hair and the chainsaw and the extremist rhetoric about cutting government down to size. And because reform in the direction of the center right had been attempted under Massa, I guess 7 or 6 years ago now, and failed and brought back the Kirchners, nobody saw Milei having a prayer. The problem with Argentina is it's filled with Argentinians. And it'll never change. It's been a rolling default for decades. And here we are. But the difference is that, people saw the hair and the chainsaw, and what they didn't see is this guy is incredibly intelligent. I mean, his IQ, I know guys personally who are much older than me, obviously, who were in class with him in economics. And they would say that Milei was top of the class. This guy is dangerous smart. And when you hear him in interviews talking about like, no, first we have to do this, then we have to do this. We need 3 months of this, and then we're going to retire the LELIQs and get the BCRA back on this. And then we need to do this. Like, here is a guy who not only came up with a plan, but thoroughly understands every point for the next 24 months, what needs to happen in order to get Argentina back on the rails. And if you sit and listen to, there was an interview with him months ago that he did with Lex Friedman. That went on for 90 minutes. Just the first 20 will blow your mind. Like, the guy's no dummy. And then I look at what's going on now. And I didn't mean to say he's no dummy to suggest that Trump is. It's an entirely different way of approaching what's going on. I don't necessarily think Trump is a dummy. I don't need to have that view. The execution of what's happening and the perception by the business and investing public that there is potentially no plan here, and then the apologisms of, no, it's art of the deal, there's a strategy. It's like, but look at the formula that was used. Look at the fact that we even had Hurd and McDonald Island on placards in front of the White House that looked like they had been printed an hour before he got up there, right? Like they ran somebody down to Kinko's to put this stuff on a cheap board. Like, if there is a plan here, it seems like they almost like are deliberately throwing mud into the water. And you can say that that's a strategy to worry everybody else on the other side of the negotiating table. Okay, maybe it is art of the deal. But I can tell you, as someone who wants to build a factory and doesn't know if he can have it done in time for 2028, that this sort of scleroticism gives them pause. For example, before the 90-day pause yesterday, and I had this exact conversation on Monday, if you run a business based on what you're seeing, and the tariffs are going from 34% for China to 68 or whatever the next one was, to 105 to, I guess, 145 was the headline I just saw on CNBC 30 minutes ago. When you take everything that he's done in, and you say, okay, I've got orders that I need to place. There's a boat already on the way here. If it lands in Long Beach, I've got to pay at least 10, maybe 34 if he changes his mind by the time we put the anchor down. Maybe I have that boat slow steam. The next order, I don't know, like they're saying they're going to negotiate one by one under 75 countries. Japan is first, and then maybe Vietnam. Maybe they get to Korea in a month. And the worst thing that Bessent did on Monday was say, we've got 70 countries lined up to negotiate, but it's going to take time because there's a lot to do here. So May, maybe June, like this is going to be a process. And the moment he said that, I said, oh my God, no, because what you want to say is we're moving very quickly. We're doing a ton of deals, but leave it hanging without a deadline, because the moment you say it's going to take 2 months, anybody who has an order for the next 2 to 3 months is going to say, okay, so I'll wait. And that means furloughs. That means a window where some items may go empty on store shelves randomly. I'm not saying, oh my God, we're going to run out of food, go hoard and buy. I'm just saying at the margin, you go on Amazon and try to buy a t-shirt for delivery tomorrow, and it says next week or next month. And you're like, huh, that's weird. And then when it comes back on, it's up $10. Like, there is a needless amount of pain happening here where you could have accomplished the same thing through defining a clear plan, which at the margin may hurt your position as a negotiator because you want to drive the screws and you have a strategy. Fine. Okay. Art of the deal. But in the meantime, you're pissing everybody off and you're shaking the very confidence of managements that you're trying to attract their investment into America with. So And
Yeah.
people don't just forget. Like, people will be talking about the insanity of the last week for a long time in the business world. Investors have like a very short-term memory. We're monkeys, but yeah.
We talked about a little too much confidence, not enough fear. That's making you a little bit nervous from investors, and yet we have a severe fall in confidence because of what you said on the part of business. I want to get this one question in because it's a good one, and we're just talking about Argentina. Zos is asking, does EM rotation hold through this where the detox is U.S. isolated, or does the long bond sell-off hammer EM flows? It's a good question.
Oh God, yeah, it's a great question, and this is the thing that actually I spend the most time on. Let me answer that question with a simple yes. I I am open-minded. Some days I wake up and I think it's a great rotation trade, but that involves such a degree of imbalance that Europeans, I think, own something like 17 to 20% of U.S. equities. But the market, that number is so much bigger liquidity-wise than their European markets that, trying to sell 1.7% or just 10% of their holding to buy Europe would involve increasing their local holdings by something double digit, I think like 10 to 15%. So it's elephants through a keyhole in terms of the flow. There's simply no way to move that money into a place like Brazil, never mind in Argentina, which is so much less liquid. But then on the flip side, sometimes risk off is just risk off. And, the fact that when the boats slow down and the orders stop coming for a few months, China feels it too. I'm wrestling with the old notion that we used to say, when America catches a cold, the rest of the world gets the flu. I think that may actually come first now, before the rest of the world sort of inflects in a few quarters higher and sooner, precisely because a weakening dollar is very stimulative for them, so long as they can trade with each other. I don't know, Maggie, I don't have a clear answer. It is an excellent question, and possibly the question for me, because I have a lot of long EM exposure, particularly with Brazil, which I've been vocal about, just based on valuation and sentiment, and getting paid to wait, in 9% in dollar terms for Brazilian equities. It's a decent amount of carry to be involved in, but it's not without a lot of risk. And the one thing that gives me a little bit of solace is that in the past, when EMs get rocked, it's because the dollar is screaming higher, and that's what's precipitating a broader risk off in both the U.S. and the rest of the world, right? And so, if the dollar were to turn here because everybody's bearish on the dollar, and we get a real risk off where the dollar is ripping, and there's some kind of liquidity event that's hiccuping everybody, then yeah, I would be worried about the detox period not being isolated to the U.S. But there are some days where, as you can see today, emerging markets get rocked along with everything else, because correlations are starting to go to one in that general degrossing by U.S. multi-strat pods, European pensions. Everybody's, kind of trying to manage their gross around elevated levels of volatility at the same time. And EM is going to get caught in the crossfire despite a weaker dollar. So it's very hard. It's a fantastic question. Thank you for the question. I have more questions than answers, as you can tell. I don't mean to dance around it, but this is how I'm thinking about it.
Yeah, no, I think that just sort of laying out how you're approaching it is super helpful. We only have a couple more minutes left because, as I said, this is the markets are moving, and I got to let Paolo get back to it. But want to ask this because I think it's specific to some stuff you've been writing about. How do you square a negative view on MSTR, MicroStrategy, Bitcoin with a bearish treasury outlook? If the Fed is forced to bail out bonds with QE, won't Bitcoin fly?
So I'm not anti-Bitcoin, although I do. I exhibited a lot of skepticism post-November, where we had a huge kind of vacuum rip, and I traffic in sentiment and narratives, and it worries me when the Hawk Tuah girl is launching a moon coin that goes to zero, and a football player like Odell is bragging about taking his Rams salary in Bitcoin. It's like, guys, weren't we just there 3 years ago when Tom Brady was put laser eyes on and then lost it all, like including his wife? No offense, Tom, if you're a sub, I feel for you. It's like if an athlete is taking a chest thump. Like I start to get really concerned that we're back, in mania territory, and who can possibly deny some of the behavior that we saw, like, unicorn fart coin and all this other nonsense post the election. I'm not against Bitcoin per se. And I do see its attractiveness as a kind of, I can understand why people are gravitating to it as to a narrative of flight to safety, like a store of value away from the financial system, et cetera. But there's no denying that liquidity has fueled its rise, especially its parabolic moves over the last 10 years. And I just know that we don't resolve what we went through last year that culminated in the nonsense of November, December, by going sideways. And as we can see, literally while we're talking, it seems to be completely falling out of bed. Again, the degrossing will catch even people's favorite assets and the purest favorite assets in the crossfire. My vitriol and my short is, I'm not short Bitcoin, to be clear. My sort of anathema and focus is on Mr. because of the pyramiding of a capital structure, a leveraged ownership, clear signs that this guy is over his skis. It's just, for me, it's got all the wrong capital structure. You've layered in credit and borrowing to buy Bitcoin. This will not end well. It'd be no different than the Hunt brothers, buying silver by lending, borrowing against their existing silver, which is what they did in 79. They would go to Swiss banks, pledge their existing silver as collateral to borrow more money from Swiss banks, to then turn around and buy more futures and take delivery of some of those futures, pyramid that silver back to Swiss banks, borrow against it. I mean, how is what he did here any different? The market is going to find you. There is a lack of respect for the market and what this man has done. And I'm here for it, especially when you layer in the fact that there are levered ETFs. So there's retail that's not just willing to underwrite this nonsense, but to do it with leverage in third-party instruments.
Yeah.
I can't make my warning more clear that this thing is an accident. And I think it unfolds very, very soon, if not already. And flushing him out of the market will be healthy eventually for Bitcoin, right? Because you eventually, you perfect the collateral in getting the weak hand out. But that's going to be a painful process because, if creditors need to take the coins, they also need to sell them. I don't know. I would be very careful with both here, especially because, he's not far away. His basis is 67,000. And there was very little volume on the pop in November following the election from 72 to mid 80s. Markets don't like volume voids. So I would, my target initially would be like 70 on Bitcoin just in the near term, next couple of months, because we're going to find that level where the volume comes back. And there are a lot of guys who are stranded above mid 80s, who are, following, Sailor is just a poster child, but there was a lot of retail that bought up there. And so we got to flush them out. And the problem is that his basis is 67. So, market's going to go find him. And I don't want it to happen. I only root for it because I have a position. It's impossible not to root for your book, but I know what the market is eventually going to want to do to him. We've seen this before.
So be careful. I think listen, that can be said in so many ways. We're going to wrap. Last question as we go, and I'm sorry, there were a couple questions about commodities. Jump in Paolo's chat. If you're a subscriber, if you're not, you should, and you can ask him directly when he is available for that. But I want to ask, what market are you watching? So you're clearly very concerned that we're in for a multi-month, multi-inning, volatility downdraft, and that this is part of a sort of potentially a paradigm change here. What market is leading, do you think? Is it the bond market that we should be watching? You're watching JGBs, I believe. Are you watching gold? Are you watching like a decoupling of certain assets? Like, what should we be watching as the lead to know whether this bearish scenario is going to play out? Or if we have to think of the bull side?
Yeah, so I actually try to watch everything. And what I've seen over the last week, somebody had a funny meme up this morning on Twitter where he took that first contest scene from Squid Game where they're all playing red light, green light. And as they all start to get shot, like he's got little captions of every position in the market that's just like made headlines and blowing up, swap spreads. And it ends with, no offense, I thought it was funny. It ends with Bill Ackman's reputation because of all the he seems to like to post.
Sorry, Bill.
Sorry, Bill. But it was funny because, it is precisely in a degrossing where you sort of have to watch everything. Tony G likes to say head on a swivel, because as people degross and they sell one thing, it forces someone else who has a position in something relatively unrelated to then make a decision to potentially sell that, which is why you've seen on some days things are selling off seemingly randomly at different times or even across days. So there are days where Bitcoin will suddenly completely fall. Well, classic example, last Friday, we had a very nasty sell-off, right? It was day 2 of post-Liberation Day selling, but Bitcoin actually hung in and, MicroStrategy was up on the day. And you would have thought going into the weekend, and there were even some, commentators I respect. It's like, if you're a purist and respect the tape first, the tape is telling you that Bitcoin's okay, right? So maybe that's not where you want to be short. But where that kind of logic misses is, I don't want to use the word like moment of crisis, but in a moment of deleveraging rapidly and where people are making decisions very quickly, they start to sell something that's working and they start to sell what they can, not what they want. And anything that has a bid and that's still doing well, they'll hit. But they arrive at these moments of decision at different times. So I don't mean to duck your question. I actually invert the question by saying there's not one thing I'm watching. I mean, for me, the U.S. bonds are the center of the universe because that's the basis for leveraging across the financial system globally. I think equities have kind of grown from the tail that wags the dog to the dog, but it's a crapshoot on any given day because it's become Donald Trump's Twitter plaything, as we've seen. He almost seems to relish it. So I would watch everything, but I'm watching the tape as we speak right now and seeing Bitcoin suddenly fall 4,000 while equities continue to kind of gently bleed lower. Granted, down 4% is a hell of a bleed, but seems orderly. But suddenly the 30-year bond gapped, 5 basis points out of seemingly nowhere. So these are hallmark signs of a rolling degrossing. The imagery I use is a rolling crack up, where one thing touches off the next, touches off the next, touches off the next. This usually ends one of 2 ways if it goes on for long enough and the stress builds. Either it ends in a giant correlation to one risk off type of event, which is not to scare people, it's just the historical precedent, or there's some manner of intervention either by Trump with his tweets or by the central bank to address the issue of players needing to degross by stepping in and backstopping the degrossing. We can get into more detail another time on that. The basis trade gets a lot of attention because of the leverage involved in carrying these positions, not the risk of the positions themselves, because it is, in theory, a risk-free arbitrage, but for the fact that you have to leverage the trade to squeeze $1 out of it. So the problem is the leverage, not the trade. What if you were to give that trade entirely to the Fed? That was on Bloomberg a few days ago. There are things that can resolve these rolling crack-ups and touch-offs. But for now, it's interesting to just watch which one touches off the next, touches off the next. If there is one thing that I'm watching like a hawk today, and it's only because it's become an enormous position for me since Monday, is the long bond. Because that is the one thing where, absent an unlimited bid from someone like the Fed, who has unlimited money, a la March of 2020, there is no tweet that Trump could say, or that Bessent could, a statement that Bessent could give, that the market would believe to underwrite a longer term long position in the bonds, in my opinion. It's either crash risk to force people into the bond market, and even that doesn't seem to be working, or change your stripes and say, no tax cuts. We really are serious about eliminating the deficit first, even if it hurts. No automatic stabilizers even. forget unemployment insurance, like we're going to crash the system, then the bonds may work. But absent that, I worry for the bond market, because everything that I see from narrative space, the statements made by the missionaries in the market, is they don't respect the bond market and the guy who locks in his money for 30 years at a time when term premiums, the premium for basically think of it as what short-term interest rates will be on average over the next 30 years. It's not the same as the difference between Fed funds and the 30-year. It factors in the elements of the path of what the Fed will do over the next 30 years is too low, given the uncertainty of what we're in for in the next couple of years. Investors are not being paid enough on the long end. And this is emerging market territory when it all comes home. Like, that's why I say DMs are becoming, developed markets are becoming emerging markets, and the US is speaking Portuguese without even realizing it. This is what I mean. It's when you get risk off and the bonds don't help you. We got a taste of it in 22, and people thought that it was an aberration. For me, to answer your question with a very long answer and now a short one, if there's one thing that I watch like a hawk, it's the long end of the bond market, because that for me is like, it's the black hole at the center of the Milky Way right now,
Yeah. I have so many follow-up questions, but I'm not going to ask them, because you got to get back to trading with this giant position and watching the markets, which are really starting to move. So I'm going to let everybody go do that. But Paolo, amazing to have this conversation. Thank you so much. Your Substack's awesome.
Thank you.
And we'll catch up again, because I have a feeling this is going to be going on, and I'm going to see you soon. So really looking forward to that. But everybody, listen, take care and good luck out there, as we say, and try to keep your heads on. All right.
Yeah.
Take care.
Yeah.
Thanks, Paolo. Good
Thanks,
luck today.
Maggie.